IT consulting major Accenture recently announced its second quarter results for fiscal 2022, beating Wall Street estimates. The Dublin-based company reported revenue income of $15 billion, registering a growth of 24% year-on-year in dollar terms and 28% in local currency. It also saw record order inflow of $19.6 billion, rising 26% year-on-year in local currency. However, what surprised the markets was Accenture's sharp upward revision in revenue guidance. The company now expects revenue growth in the range of 24 to 26% in local currency for FY22, which is up from 19 to 22% pegged last quarter. It had pegged revenue growth in the range of 12 to 15% at the start of the fiscal. Analysts say Accenture's strong revenue growth led by broad-based demand driven by accelerated cloud and digital transformation is a positive for Indian IT. The increase in FY22 growth guidance despite uncertainty from the Russia-Ukraine conflict further pins hopes of robust order pipeline. Motilal Oswal Financial Services highlights that Accenture's positive commentary indicates a healthy pipeline and strong spends in areas of digital, cloud, Web 3.0, and security. Only 30% of workload is on cloud, and thus acceleration of cloud adoption will open further opportunities for IT companies and provide a sustained demand environment. It also said, given Accenture's tendency of increasing guidance over the quarters, its Indian IT services peers would be closely watched for their commentaries on FY23 as expectations on growth escalate. That said, not all is well for the Indian IT companies. According to DStreet Mavens, even though Accenture's numbers look impressive, they highlight pain for its Indian counterparts. For instance, Accenture has been clocking record order wins in large size segment, while Indian IT companies are focusing on mid and small order sizes. The company has also seen accelerated market share gains in FY20 to FY22 compared to TCS and Infosys, and has been talking about 3 times industry growth in recent days versus 2 times in the past. To be sure, Accenture does benefit from strong capabilities across digital areas in consulting and outsourcing, which are preferred by enterprises undertaking digital transformation programs. But this has aided the company in outperforming Tier 1 Indian IT companies.
We believe Accenture benefits from strong capabilities across digital areas. With a large presence in cloud, where at $18 billion in terms of revenues, they're larger than the overall revenues of a lot of tier 1 Indian IT companies. They have strong presence in cybersecurity, SaaS, as well as Industry X. In addition, they combine both consulting and outsourcing capabilities, which are preferred by enterprises undertaking digital transformation programs. Accenture's materially larger digital practice with 70% plus of revenues coming from it and has been ahead of competition in terms of identifying areas of investments. We believe Accenture's results might have some positive rub-off for Indian IT, but nuances like Accenture's stronger portfolio, consistent outperformance versus tier 1 IT, deal win strength relative to tier 1 Indian IT companies, and differentials on growth against companies like Infosys and TCS, which are materially smaller, limit material extrapolation of strong Accenture results to Indian IT. We believe tier 1 IT might have peaked on growth in 3Q. We expect normalization ahead to more like pre-COVID growth rates by FY24. Weakening macro, savings in captive or asset takeover deals, and weaker large deal momentum will be drags in our view.
The second red flag for the Indian IT companies comes in terms of margin guidance. Accenture has lowered FY22 EBIT margin improvement guidance to 10 basis points for the fiscal, which suggests elevated supply pressures. Given this, GM Financial says there are potential risks to margins from likely rebound in travel expenses in H1 FY23 itself and elevated supply side pressures exacerbated further by the recent Ukraine crisis. Ambit Capital expects growth of Tier 1 IT companies to moderate from 17.7% year-on-year in constant currency in FY22 to 11.7% and 8.1% in FY23 and FY24. The third headwind for Indian IT emerges from outsourcing income, which accounts for a very large part of Accenture's revenue. Indian players like TCS, Cognizant Technology Solutions, Infosys, Wipro, HCL Technologies, and Tech Mahindra are in direct competition for the same. Against this backdrop, IT shares pared their gains and ended lower on Monday, with the Nifty IT index dipping nearly 2% from the day's high and closing 0.7% down. Let's go to Business Standard's Abdul Bhakkar to see if these headwinds are showing any downside pressure on technical charts.
The overall trend for the IT stocks hasn't been so great recently. Although Nifty IT index managed to hold on the 200 DMA support, which even the benchmark indices Nifty 50 and Sensex failed to do so in the recent correction, the trend for the IT index and the IT stocks hasn't been so thrilling. Stocks like Infosys is doing pretty well at this moment. It is showing a gradual upside in recent days, and it can rise towards 2000 levels as long as it trades above 1800, which is its support mark. Stock like TCS, it needs to sustain above the resistance of 3700, and when it does that, it can rise towards the next resistance of 3900. When it comes to stock like Wipro, which is also showing a gradual upside, now the stock has come to a resistance of 200 DMA placed at 617, and if it manages to conquer and sustain above 617, it can give further upside and can reach to 640 as well.
Net Accenture results present a mixed picture for the Indian IT players, with visibility of a sustainable demand, but margin pressure and market share headwinds looming large. On Tuesday, global cues and stock-specific action will sway the indices amid lack of domestic events. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.